Fundamental ethical and professional principles are essential to the effective application of IFRS accounting standards because financial reporting depends heavily on integrity, transparency, and professional judgment. The DIP-IFR syllabus emphasizes that accountants and finance professionals must not only understand technical accounting requirements but also apply them ethically in practice. Ethical conduct ensures that financial statements provide a true and fair representation of an entity's financial position and performance. Without strong ethical standards, financial reports may become misleading, reducing investor confidence and damaging the credibility of capital markets. IFRS accounting standards are principles-based rather than purely rules-based, meaning professionals must often interpret standards and apply judgment responsibly when dealing with complex transactions, estimates, disclosures, and measurement uncertainties. One of the most important ethical principles in financial reporting is integrity, which requires accountants to act honestly and avoid misleading statements or omissions. When preparing IFRS-compliant financial statements, professionals may encounter pressure from management to manipulate earnings, conceal liabilities, or present financial information in a way that benefits the organization unfairly. Ethical compliance requires resisting such pressure and ensuring that financial information remains accurate, complete, and unbiased. Integrity is particularly important in areas involving estimates, such as impairment testing, fair value measurement, provisions, and revenue recognition. Accountants must ensure that assumptions and judgments are based on reliable evidence rather than personal interests or management incentives. Maintaining integrity protects stakeholders and reinforces public trust in financial reporting systems. Objectivity is another critical professional principle in complying with IFRS accounting standards. Financial reporting professionals must avoid conflicts of interest, bias, or undue influence that could impair professional judgment. In practice, objectivity can be challenged when accountants work closely with senior management or face performance pressures linked to financial results. IFRS accounting standards often require significant estimation and interpretation, especially in areas such as lease accounting, deferred taxation, financial instruments, and fair value assessments. Professionals must evaluate evidence independently and ensure that accounting decisions are supported by economic substance rather than desired outcomes. Objectivity also requires transparent disclosure of significant assumptions and uncertainties within financial statements. By maintaining independence and impartiality, accountants enhance the reliability and comparability of financial information provided to stakeholders. Professional competence and due care are equally important in ensuring proper IFRS compliance. Because IFRS accounting standards evolve regularly to address emerging business practices and global reporting challenges, accountants must continuously update their technical knowledge and professional skills. Failure to understand or correctly apply IFRS requirements can result in material misstatements, regulatory penalties, reputational damage, and reduced investor confidence. Due care requires professionals to perform their duties diligently, thoroughly, and in accordance with applicable standards and regulations. This includes maintaining appropriate documentation, evaluating complex transactions carefully, and seeking expert advice when necessary. Accountants are expected to apply sound judgment, exercise skepticism, and ensure that financial reporting decisions reflect both technical accuracy and professional responsibility within international reporting environments. Confidentiality and professional behavior also form essential components of ethical compliance within IFRS-based reporting. Accountants frequently have access to sensitive financial, strategic, and operational information that must not be disclosed improperly or used for personal advantage. Maintaining confidentiality protects organizations, investors, and other stakeholders from financial harm and reputational risks. At the same time, professional behavior requires compliance with laws, regulations, and professional standards while avoiding conduct that could discredit the accounting profession. Ethical challenges may arise when organizations attempt to delay disclosures, manipulate sustainability information, or avoid reporting significant liabilities. Professionals must balance loyalty to employers with their broader responsibility to investors, regulators, and the public interest. Ethical conduct therefore strengthens accountability and promotes confidence in international financial reporting systems. Overall, ethical and professional principles are fundamental to the successful implementation of IFRS accounting standards and the credibility of global financial reporting. Technical compliance alone is insufficient if financial statements are prepared without integrity, objectivity, competence, confidentiality, and professional behavior. The principles-based nature of IFRS requires accountants to exercise informed judgment while ensuring that financial information faithfully represents economic reality. Ethical failures can lead to financial scandals, loss of investor trust, and significant economic consequences for organizations and capital markets. Consequently, the DIP-IFR program emphasizes that ethical responsibility is inseparable from technical accounting expertise. By applying strong professional values alongside IFRS knowledge, accountants contribute to transparent reporting, effective corporate governance, and sustainable confidence in international financial markets.